Hello and welcome to this week's special presentation. My name is Jim Penna. I'm the Manager of Retirement Services here at VectorVest, and I'm very happy to be hosting this week's topic, which is titled Earnings, the Engine That Drives the Market. As earnings season approaches, actually kicking off today with the major banks reporting today, I believe it's important that we take a look at what Dr. DiLiddo had always reminded us of about how the market works, and he always said that earnings is the engine that drives the market. Earnings information serves as a crucial foundation for stock investment, offering insights into a company's financial health, growth potential, and future prospects. By analyzing earnings, investors can gauge profitability and make informed decisions about buying, selling, or holding their stocks. My goal in tonight's presentation is to show you how the VectorVest program not only supplies you with the earnings information that you need, but also how to apply that information to drive your portfolio to greater profits. So the first thing I want to do is refer you to a presentation that Dr. DiLiddo had presented so many times, and back on September 8th, it was a special presentation replayed in honor of Dr. DiLiddo, and it's called How the Market Works. If you haven't seen it, I strongly urge you to go watch it. If you have watched it, I urge you to watch it again. It's a classic, very informative presentation, and I strongly urge you to watch that. And the first thing I'd like to do is go into the VectorVest program, and I'm going to bring us to the Graphs tab, and I want to start with the market climate graph, because the two pieces of information I left out of the title of this presentation is really how the market works, and what drives the market is earnings at its core, but it also has to do with inflation and interest rates, which we've heard a lot about over the last year and a half or so. So that's what we're going to look at in the market climate graph. So I want to begin here with the basic setup. At the top, we have the moving average of earnings per share for the VectorVest S&P 500 watch list. So we track earnings here, and then down below is the earnings trend indicator. And each Friday in the earnings update, we talk about how these numbers have moved. They are on a weekly basis. And as of April 5th, so this is last Friday as I record, the 50-day moving average of earnings per share for the S&P 500 was at $10.02. And our earnings trend indicator, which is on a 0 to 2 scale, remained at 1.09, where it's been for the last few weeks. So even when earnings were falling here, they stayed above 1 on that 0 to 2 scale, and so we never really went into a bear market scenario using the data that Dr. D uses to describe the 8 different market scenarios that we track. Here in the market climate graph, you have the ability to add other information, and the way that I like to just set mine up, and you can do it however you'd like, you can add parameters. Whenever you see the VV here is putting it on that 0 to 2 scale, but I put on CPI, I put the commodities on, and I put T-bills and T-notes, right? I'm looking at earnings, interest, and inflation. And you can get a sense of where these numbers are going. One that stands out is the commodities, CRB, are rising. CPI, even though it's come off its peak, it is still being very stubborn and not moving down. Had a hotter inflation report this past week on CPI than expected, and we saw what that did to the overall markets. And we can see what's happening to the market today. We'll go back to the homepage where JP Morgan announced earnings that they beat estimates on the earnings per share and the bottom line, and yet still some warnings and some caveats have pushed JP Morgan lower, at least through today, along with the rest of the market. So interesting to see how that affects the overall market. What I like to do next is go into the Views tab. And what I've done is taken us to last Friday's VectorVest Views in our extended newsletter. And I scroll down here, when you come to the climate section, okay, I think it's very important to read through the important macro numbers that we see. So you can read through that climate section here. It then brings you to the current market scenario. We are in a case 4 bull market scenario currently. We can take a look at the earnings trend indicator. So we know earnings are rising because that trend indicator remains above 1. inflation is rising, interest rates are rising. So when we put that on the 0 to 2 scale, you'll see it's below 1 because remember, anything below 1 is unfavorable. So with inflation and interest rates down below 1, it's telling us that they're both rising. Now, finally, to wrap the truth chart up here, we're in a case 4 bull market scenario. Earnings, inflation, and interest rates are all rising. But as long as earnings are rising, you'll see of the 8 scenarios, anytime earnings are rising or the earnings trend indicator is above 1, we're going to see a bull market scenario. Okay, so that's what we're looking at right now when we talk about the overall market, when we take earnings, interest, and inflation and analyze all of that in one place. Nothing better than the climate section on a Friday or over the weekend to analyze that macro view of the overall market. Very good information there in a straightforward manner that we present it. From here, I'm going to go back up to the main toolbar. I'm going to click the Viewers tab, and it's set to our stock viewer page. And we'll see Nvidia currently is the top ranked VST stock out of the over 9,200 that we're currently tracking. So I'm going to use Nvidia kind of as our example here. Down today, the overall market, again, just to talk about how those earnings and earnings worries as the banks kick off with inflation, interest rates, and earnings just really the core to where the market moves. So we see a down day today, but let's go back into the Viewers tab and let's start with Nvidia. Recently, Angie Akers has been writing some wonderful essays, again, defining and showing you how to apply the important proprietary indicators that make up the VectorVest program. Relative value, safety, timing, the VST, comfort index, all of these things are so important. Last week, Todd Schaefer did a wonderful job talking about the dividend information that VectorVest provides with our dividend yield, safety, growth, and yield safety growth vector, and how that allows you to apply that information if you're looking to add income into your stock investment programs. Tonight, what I'm going to do is focus on the columns here that start with the growth rate and just talk a little bit about how VectorVest uses this information and how you can use the VectorVest program to find the stocks that are most likely, again, to drive your portfolio higher. So let's start. I'm going to start with earnings per share. Nvidia currently has an earnings per share of $21.65. I want to go into a screenshot I took just this morning before the market opened of Nvidia. And this is a one-year graph. We're looking at the price of Nvidia here over the last year, and down below is the earnings per share. Now, the thing to remember about earnings per share in the VectorVest program is that earnings per share stands for a leading 12 months earnings per share number. Right? Nvidia currently has a forecasted earnings per share of $21.66 per share. VectorVest determines this forecast from a combination of recent earnings performance and traditional fiscal and or calendar year earnings forecasts. Now, this comes straight from our full stock analysis report, which I'll go into in a minute. Dr. D thought it was important to use the forecasted earnings, and he had written that how he went about supplying this number. And he talked about there are a number of services that provide information on earnings forecasts. Right? You can go out and get the information. And he wrote that getting this information can be expensive, however. Not getting it can be even more expensive. So Dr. D wrote that, he goes out and buys the information, or VectorVest goes out and buys the information and uses it in our program so that we can compute earnings growth rates, assess dividend safety, and calculate stock value. Okay, this is why when we get to the PE ratio, Dr. D was never a big fan of the PE ratio as an important part of analysis because it just didn't give you enough information. It couldn't be used in the way that he used earnings yield. So we'll talk about that in a moment, but here is, if you needed the proof that earnings are what drives individual stocks or the market itself, this is just one of many examples where earnings per share continue to grow, and again, both have that northeasterly direction. That's what we want to see, and that is the power of earnings growth. Which brings us to earnings growth rate, and for Nvidia, it has a tremendous earnings growth rate of 51% per year. Now, the first thing I want to do is go ahead and right click there and take us into a stock analysis report. And this is where you're going to get the definition of every proprietary indicator and how it's used in the VectorVest program. I urge you to, if you haven't, print one of these off. It doesn't matter what stock, it just gives you the definitions that you need. So I'm scrolling through the proprietary information there, the main information. It's going to take us to earnings growth rate. And in the VectorVest program, it's defined as growth rate reflects a company's 1 to 3 year forecasted earnings growth in percent per year. Okay, with an earnings growth rate of 51%, VectorVest considers that to be excellent. So the VectorVest program statistically analyzes historical sales and earnings performance. Right? It also accounts for current quarter-to-quarter changes in sales and earnings and uses forecasted earnings to target the future growth. VectorVest analyzes both sales and earnings data because they are linked in the long term. Right? It's a number that I know Todd loves to go back and talk about sales growth, and it is very important. So when you go back to sales growth, clearly there is much more to estimating earnings and growth than meets the eye. Again, this is what Dr. DiLiddo has written about the earnings growth rate, so a lot of important factors that go into that. If I come back into our spreadsheet, next we'll talk about the earnings yield. Now, earnings yield is something that, again, as I mentioned, Dr. D was never a big fan of the PE ratio. He thought it was just not enough information to really analyze the quality of the underlying stock. And so he thought earnings yield, which he called the kissing cousin of dividend yield. So just a quick look at how to determine the earnings yield. We're simply going to take the earnings and take 100 times the earnings per share, which was $21.65, divided by the current stock price, which is $8.90, and is going to give us that earnings yield, which is right at 2.43. So a basic calculation, but giving us, again, the important number. And the reason earnings yield is so important in the program is that it does factor into when we put, when Dr. D created value, relative safety, earnings yield becomes a part of that, where just a straight out PE ratio would not be of really much use. Finally, there's the PE ratio, which of course is simply the price divided by the earnings per share. And then we have the GPE, a number we don't talk too much about here at VectorVest, at least not to a great degree, but it is an important number, and it allows us to put an over or undervalued look on a stock, not in the same way. I mean, it goes a lot deeper when we show the value, right, versus price of a stock. Nvidia is slightly overvalued as we speak, but that, not a problem. I would never summarily dismiss a stock simply because it's overvalued. The first thing I do when I look at an overvalued stock is I go straight to the earnings growth rate. But things like the GPE can help as well. So what is GPE? If we go into, again, the stock analysis report, and we come down to the GPE, it is the growth to PE ratio, a number that the famous fund manager Peter Lynch used to use. And Nvidia has a GPE rating of 1.24. The stock with a GPE greater than 1 is commonly considered to be undervalued. That, by the way, that's not on a 0 to 2 scale. We consider it undervalued. Okay. Now, just to be specific, that's undervalued as it relates to the earnings information. And really all it comes down to when you calculate this is taking the earnings growth rate of 51, and again, I can walk through some quick math here, 51, and dividing it by the current PE ratio. And at 1.24, which is where the current GP is, we say that, that's a positive when we're looking at earnings. And really all you're doing is saying earnings growth is greater than the PE ratio, where the stock is currently trading versus earnings. It's very similar to what I've touched on before and what Todd touched on last week. When we're looking for a quality dividend payer, one of the things that we would always do is compare the earnings yield to the dividend yield. Okay, because you wanted to be sure that the company was making enough money to continue not only paying but growing their dividend. So here it's kind of the same idea, right? When you come and look at the earnings growth rate versus the current PE ratio, you have to be sure that the growth rate is stronger than that, right? That's how you can apply that information to find higher quality stocks. Now, again, just because a stock had a ratio or a GPE ratio below 1 would not summarily, again, dismiss the stock. Earnings growth rate is certainly important, earnings per share, and a lot of the other numbers as well. Ultimately, it's all going to come back to relative safety. As I've said many times, because earnings yield and earnings play a part when we calculate relative safety, the high relative safety number is going to usually ensure that all of these numbers are coming into place where they should be, right? Just simply by finding the high RS stocks. Okay, so that is the importance of these columns when you look at the VectorVest spreadsheet. And how to apply that information and use that information, well, that's the next step where VectorVest excels, of course, because now I could simply go into the Unisearch tool, and there are a couple of searches that we use, and it's not just because it makes it easier for me. It's the one that I use for much of what I do. It's not the only one, but it is one of the main searches and starting point for me when I begin to look for the proper stocks to build and manage my portfolio. I go to ruler stocks, right? And when I click, we'll go ahead and stream here so we can see the actual stocks that are there right now. And here's the beauty of this search. And Dr. D talked about ruler stocks in Stock Strategies and Common Sense. And he started here with stocks, the growth rate, right? Just to make this list, the earnings growth rate has to be greater than or equal to 14% per year, and the relative safety of the stock has to be greater than or equal to 1.4 on that 0 to 2 scale. So it's not surprising that the number one stock in the VectorVest database happens to be Nvidia, and it happens to be the top stock here in ruler stocks. So if I were just to go ahead and graph the top 10 stocks and ruler stocks and just take a quick look and scroll through them, again, earnings per share on the bottom here and the price of the stock up top, CELH, and you see the pattern on this subgraph here of the earnings per share and how they're moving. And again, these are one-year graphs, all rising over that year. Okay, so this is what you find when you're looking at high relative safety stocks, especially when we sort those stocks by the relative safety times the earnings growth rate. So these are the kind of stocks that are going to come up in the portfolio. In our retirement coaching group, we have a portfolio that we track on ruler stocks. It's a little over 5 years, almost 6 years going now, and it has an annualized rate of return of just under 28%, following a very prudent investment risk management plan that we use. Now, there was some drawdown through 2022 and 23. The portfolio has performed very well over the last 6 months or so. And so that's the power of high RS stocks. The other search Dr. D commented on, and number 1A on my list, is also found in the retirement folder. So when I click on retirement, it'll bring us to premier growth stocks. And let's take a look on the quality of stocks that come here as well. Parameter of earnings growth rate being greater than or equal to 14% per year. These are larger market cap stocks, and then there's just the basic information here. The key here is VST times RT times CI. Growth rate is an important part of the search, obviously. And if I go ahead and graph these stocks as well, you're going to get the same type of patterns and some of the same stocks, as it turns out, here. Again, I'm just scrolling through, and it's a very similar pattern on these stocks. As earnings rise, the price of that underlying stock rises. So that is the power. How do you apply it? Again, looking for quality stocks. Premier growth stocks and ruler stocks are just two basic examples. One final search I'll just take you to, which is a great one, again, to kind of piggyback off of what Todd talked about last week, USA's best growth and income stocks, a search that Dr. D created. So you've got not only stocks with a relative safety of at least 1.4, but they also have to have a YSG, or that yield safety growth, greater than 1. And you'll see the type of stocks that come here as well. Now, the dividend yields are not always through the roof here, but you are collecting dividends. They are very safe. And you can see the earnings growth rates, earnings per share, the yield here, and all those important numbers that we talked about. So that's just a quick update on the importance of earnings, what the important information found in the VectorVest program can tell you. When it comes to how the market works, again, I strongly urge you to go watch How the Market Works, a special presentation from Dr. DiLiddo. That concludes this week's special presentation. As always, thank you for taking the time, and I look forward to seeing you next time.
Yeah.